Welcome to Unlocking the Upside, the show that brings you deep insights into the art and science of investment analysis. I'm your host, Jeff Robinson, founder of theinvestmentanalyst.com.
And I'm James, your former buy-side analyst turned co-host, here to keep Jeff's enthusiasm in check and ask the questions you want answered.
Today, we're diving into a topic that fascinates me: pattern recognition in investment analysis. You know, James, throughout my career, I've seen countless analysts struggle with knowing when to trust their gut and when to rely on pure analysis. That's right, Jeff. And it's not just about experience, it's about developing true expertise. We'll be unpacking the difference and showing our listeners how to enhance their pattern recognition skills while avoiding common pitfalls. Pattern recognition in investing. It's the holy grail that everyone's chasing. But what if I told you it might be leading us astray more often than we think? Today, we're diving into the fascinating world where human intuition collides with cold, hard data in the financial markets.
Oh, that's an intriguing way to look at it. Can you give us an example of how this plays out in real-world investing?
Absolutely. Let's take the case of Kagra's acquisition of Beatric company back in 1990. You had a junior analyst crunching numbers, saying it looked like a great deal based on fundamental analysis. But then you had a senior analyst with years of experience who just had this gut feeling that the market would react negatively. It's a perfect illustration of the tension between pure analytical thinking and pattern-based intuition in investment decisions.
That's fascinating. So how do you think this kind of situation plays out in today's market, with all the advanced technology and data we have at our fingertips?
Well, that's where it gets really interesting. You see, this tension between analytical reasoning and experiential pattern recognition has only become more pronounced with the rise of big data and artificial intelligence. Our brains are naturally wired to seek patterns as a way to make sense of complex information. But financial markets present a uniquely challenging environment where cause and effect relationships are often obscured by countless interacting variables.
That makes me think about Carneaman's work on System 1 and System 2 thinking. How do you think investment professionals navigate between quick, intuitive judgments and slower, more analytical thinking?
That's a great connection to make. Carneaman's work is incredibly relevant here. Investment professionals are constantly toggling between these two modes of thinking. What's really striking is that research shows 92% of CFA charter holders consider the ability to construct coherent narratives from available facts as crucial to their decision-making process. This really highlights both the prevalence and the potential dangers of pattern-based thinking in professional investment analysis.
Wow, those numbers are pretty striking. Do you think this heavy reliance on pattern recognition might actually be leading us astray in some cases?
Oh, absolutely. And that's where we need to make a crucial distinction between expertise and mere experience. Gregory Northcraft's work on predictive models shows that true experts develop mental frameworks that can reliably predict outcomes, while those with just experience often possess models that lack real predictive power. It's not just about how long you've been in the game, but how well you've learned from your experiences.
That reminds me of Phil Tetlock's study about expert predictions. Didn't he find that a large number of experts making thousands of predictions performed worse than simple algorithms?
You're spot on. Tetlock's study looked at 284 experts making 28,000 predictions and found that they often performed worse than chance and frequently worse than simple algorithmic approaches. It's a sobering reminder of the limitations of human judgment, even among so-called experts.
So how do different types of investors approach pattern recognition? I imagine quantitative and fundamental investors might have very different methods.
You've hit on a key point there. Quantitative investors are essentially trying to systematize pattern recognition to minimize cognitive biases. They use sophisticated decision support systems to identify factors associated with excess returns, like the value factor where stocks trading at lower multiples have historically outperformed. Fundamental investors, on the other hand, rely more heavily on intuitive pattern recognition, in analyzing specific situations. They often try to identify analogous historical situations and extrapolate potential outcomes.
That's really interesting. But how do these approaches hold up in today's increasingly complex market environment?
Well, that's where Blake LeBaron's research becomes particularly relevant. He's shown how market patterns can emerge and dissolve as participants adapt their strategies. Importantly, he's found that market crashes often follow periods where trading strategies become too homogeneous. It's like the market itself is constantly evolving to invalidate the patterns we think we've identified.
So you're saying that the very act of recognizing and acting on patterns can make them disappear? That sounds like a real challenge for investors.
Exactly. It's what makes financial markets so different from something like chess, where patterns stay constant. In markets, the moment enough people recognize a pattern, it often ceases to be useful. This dynamic nature means that successful pattern recognition in investment analysis requires constant updating and validation of mental models, and
that must create some real challenges for traditional fundamental analysis. How can investors adapt their pattern recognition skills to keep up?
Great question. One key approach is focusing on what we might call stable patterns, those with clear causal relationships and consistent historical precedents. For example, the tendency of sales growth rates to regress toward the mean over time is a much more reliable pattern than short-term price movements. But we also need to be extremely aware of our tendency toward apophenia, seeing meaningful patterns in random data.
Oh, apophenia. That's an interesting concept. Can you elaborate on how that plays out in investment analysis?
Sure thing. Apophenia is this human tendency to see meaningful patterns in random data, and it's a huge problem in financial markets, where random fluctuations often mask genuine patterns. Even experienced investors can fall prey to this bias. Benjamin Graham, the father of value investing, talked about the tendency of the speculative public to count to three in extrapolating trends. Essentially, we see a pattern start to form and we convince ourselves it will continue, even when there's no real basis for that belief.
That's really fascinating. So how can investors protect themselves against this kind of cognitive bias?
Well, there are several strategies that can help. One is keeping detailed decision journals to track your pattern recognition successes and failures. This allows you to measure your forecast accuracy over time and identify areas where your pattern recognition is most reliable. Another approach is using reference classes, placing current situations within broader historical contexts. This can help counter the tendency toward overconfidence in pattern-based predictions.
Those sound like really practical strategies. Do you think there's also value in studying failed pattern recognition attempts?
Absolutely crucial point. In fact, studying failed pattern recognition might be even more valuable than studying successes. It helps us identify our blind spots and cognitive biases. When we look at our failures, we often find that we were seeing patterns that weren't really there, or we were overconfident in our ability to predict outcomes based on past patterns. And
that makes a lot of sense. It seems like becoming a better investor isn't just about getting better at recognizing patterns, but also about getting better at recognizing when we're seeing patterns that don't actually exist.
Precisely. And this is where the integration of quantitative tools becomes so valuable. They can help us verify whether the patterns we think we're seeing have any statistical significance. But we also need to remember that even sophisticated quantitative models can fall prey to their own forms of pattern recognition errors. It's about finding the right balance between human intuition and systematic analysis.
How do you see this balance between human and machine pattern recognition evolving in the future?
I think we're moving toward what you might call an augmented intelligence approach, where human pattern recognition abilities are enhanced by, but not replaced by, machine learning and artificial intelligence. The most successful investors will be those who can effectively combine their intuitive pattern recognition skills with systematic analytical approaches.
That's a really compelling vision for the future of investment analysis. It's not about choosing between human intuition and machine analysis, but finding the right way to combine them.
Exactly. And what's particularly exciting is how this combination might help us identify and exploit patterns that neither humans nor machines could recognize on their own. Think about how machine learning could help us identify subtle market patterns, while human intuition helps us understand the underlying causal relationships.
That's really interesting. Do you think this might also help address some of the cognitive biases that traditional pattern recognition approaches are prone to?
Absolutely. By combining human and machine capabilities, we might be able to develop more robust ways of testing and validating pattern recognition. For instance, machines could help us identify when we're falling prey to confirmation bias in our pattern recognition, while human intuition could help us understand when machine-identified patterns might be spurious or unlikely to persist.
So it's really about creating this virtuous cycle where human and machine capabilities enhance each other rather than competing with each other.
Precisely. And I think this points to a broader truth about the future of investment analysis. Success won't just be about having better data or more sophisticated algorithms. It will be about having a better framework for integrating different types of pattern recognition and understanding their limitations.
That really brings us full circle to where we started with the Kagra case, doesn't it? The challenge isn't choosing between fundamental analysis and pattern recognition, but finding ways to make them work together effectively.
You've hit the nail on the head there. The future of investment analysis lies not in choosing between art and science, but in finding ways to combine them that enhance their strengths while minimizing their weaknesses. It's about building a more sophisticated understanding of pattern recognition that acknowledges both its power and its limitations.
As we wrap up, what do you think are the key takeaways for investors looking to improve their pattern recognition skills?
Great question to end on. I'd say the key takeaways are, first, always be aware of your own cognitive biases and the limitations of pattern recognition. Second, use a combination of quantitative tools and human intuition to validate the patterns you think you're seeing. Third, focus on stable patterns with clear causal relationships rather than short-term fluctuations. And finally, never stop learning and adapting your approach as markets evolve.
Those are really valuable insights. It seems like the future of successful investing will belong to those who can navigate this delicate balance between art and science, intuition and analysis.
Absolutely. And as we move forward, I think we'll see more and more innovative approaches to combining human and machine capabilities in investment analysis. It's an exciting time to be in this field, and I can't wait to see how these ideas continue to evolve and shape the future of investing. Before we wrap up today's episode about pattern recognition, I want to share something that perfectly exemplifies how technology and expertise can work together. Throughout my career analyzing markets, I've always believed that successful investing requires both systematic knowledge and practical wisdom. That's exactly why I created Insight One. Insight One is where decades of real-world market experience meets cutting-edge educational technology. We've taken the pattern recognition principles and analytical frameworks I've developed over years of working with major financial institutions and transformed them into an interactive learning experience that adapts to your needs. What makes Insight One unique is its ability to help you develop both the systematic and intuitive aspects of investment analysis. Whether you're starting your investment journey or looking to refine your analytical skills, you'll learn how to balance quantitative analysis with pattern recognition in a way that's practical and actionable. Find us on the App Store, Google Play, or at theinvestmentanalyst.com. Start developing your investment expertise today.